As an investor, it can get very stressful and very confusing when you have multiple companies reporting earnings in a week. Especially when you have 30 positions in your portfolio, you don't know where to start. That's why in today's video, we'll be going over some of the companies that reported this week and that are in my long-term dividend growth portfolio. And guys, this information takes a lot of time out of my day to, research and find, so it would mean a lot if you guys could smash the like button and subscribe, because I really do want to make this channel bigger and help people learn about financial literacy. And with all that out of the way, let's get right into the video.
Hello, I like money.
First off, we'll start with KimberlyClark. Currently, I have 3 shares of KimberlyClark and look to add more when it's below 130. In Q2, consumer tissue volume fell 15% for KimberlyClark. They've also updated their outlook for their earnings in the future due to inflation and pulp concerns. New CEO Michael Hisu said that we're facing significantly higher input costs and a reversal in consumer tissue volumes from record growth in the year-ago period as consumers and retailers in North America continue to reduce home and retail inventory. This will probably force them to hike prices, which is another issue that they've had to be dealing with. Now, I don't really view this as a long-term threat because all their competition is going to have to deal with this as well. This is something that's been happening with KMB, so it's really not a concern for me. It's also not a threat exclusive to KMB. Next, we'll talk about my favorite industrial stock, 3M. To start off, 3M beat their EPS by 31 cents and beat on total revenue. First of all, that they said their adjusted profits were at $2.59 a share. That would be up 45.5% from the same period last year. They also saw huge growth in their N95 masks as they grew in 23.5%. And I think that sector is only set to grow with the Delta variant and people worrying about that. Overall, this is great to see from 3M and definitely a position that I want to have a cornerstone in my portfolio long term. Next, we'll move on to my second favorite technology stock, which is Microsoft. To start off, they returned $10.4 billion to shareholders in the form of share repurchases. This is a 16% increase and really hypes me up as a dividend investor. Microsoft also beat EPS by 25 cents and beat total revenue. For some reason, the stock went down, which is a general theme when happens with technology companies when they kill their earnings. Speaking of killing earnings, now we'll talk about Apple. Believe it or not, Apple had another blowout quarter. This is ridiculous. Apple grew 36% in total revenue year to year. And for the fools who say that Apple isn't a dividend stock, that money will be used for dividends in the years to come. To start off, they beat EPS by 29 cents. They saw big growth in their segments as well. Mac revenues are up 16%, iPad up 12%, their smallest segment, wearables, home, etc., up 36%, and services up 33%. Believe it or not, as usual, the stock really didn't react much. This is becoming the standard for Apple earnings, and I love it. The second last company we'll go over is McDonald's. They beat their EPS and total revenues. Revenues were driven by average check growth, digital, and delivery. They also saw a lot of help and relief from the BTS meal. Last but certainly not least, we'll go over one of my top 6 positions at the moment, which is Starbucks. Year to year, Starbucks grew in revenue 78%, which is insane. They saw soaring sales from their cold drinks. The coffee chain unfortunately did go down because of slower recovery in China. If you haven't been paying attention, this really doesn't matter to me because their stock was really rich anyway at $125. They beat their EPS and their expected revenue. I haven't been buying into Starbucks recently because I think it's been very rich at price, but after these earnings, I'll definitely be making sure to dollar cost average into this position. Now here's an interview.
Here, shares of Starbucks on the NASDAQ moving lower despite an earnings beat. Joining us now, first on CNBC, is Starbucks President and CEO Kevin Johnson. Kevin, we always enjoy you coming on the show, good or bad. I thought this was a good one, but welcome.
Well, good morning, Jim.
Kevin, you're doing something that I didn't think was possible. It is very clear that you're doing custom made at scale. Is that technology? Is that your team being proficient? Or is it just you have the right drinks and people just know what to ask for and you guys are ready?
Jim, one of the key differentiators of Starbucks is the fact that we've got a great beverage platform that resonates with customers, and it's customized, it's personalized for each and every customer. And you're seeing that's one of the things that is powering these record results. You point out we had a significant beat on top line revenue, a significant beat on earnings per share, and this was a record quarter. And in many ways, it was a record quarter because of the customer experience we create in our stores, the beverage platforms that we've introduced, and digital. And those three elements, the customer experience, beverage, and digital, are powering these results.
All right, now, just so you know, and David, we want to post this for you. Google's down today, so well, it's barely up. So you know that it doesn't really matter what Starbucks says. Kevin, I think that's very interesting. People are going to say, well, wait a second, why is it down? And there was a JP Morgan analyst who basically said the ticket was actually down in China, which isn't very common, especially in an inflationary environment, and that China is not doing well. Can you put that in context, please?
Well, the best way to look at this, Jim, is if you look at revenue growth in China over a 2-year period. So let's just take fiscal year 19. We grew revenue 23% in China over fiscal year 19. 2-year revenue growth, 23%. That's double-digit top-line growth. And much of that is a combination of our new stores that we're opening. The new stores we're opening in China are performing at higher revenue levels and higher profitability than prior generations, which means the brand is resonating with our customers. And so, I think this was a record quarter in China. When you look at that top line revenue growth, the new stores that we've opened, and the fact that we've increased digital customer relationships in China to over 17 million. And so the brand continues to resonate very well in China. Our comps have accelerated, 2-year comps have accelerated, and we post 23% 2-year revenue growth in China.
All right, Kevin, the wise guys are telling me, well, wait a second, coffee went up 50% last week. I tell them that you actually thought that coffee could go up, and you prepared for that. So could you explain to people how it's possible that Starbucks is not being hurt by the rising price of coffee?
Well, certainly, if you look at the commodities price of coffee, the C price, it's gone up significantly lately. A lot of that is due to weather in Brazil. But what people don't know is, at Starbucks, we have a coffee buying strategy that we buy our green coffee 12 to 18 months in advance. So we are already price locked for more than 14 months, which means we've already purchased the green coffee that we need, the Arabica coffee, certainly for the rest of this fiscal year and for most of fiscal year 22, and we've got it warehoused. So, not only do we have a great cost basis for that coffee, but we have supply, adequate supply. We're not going to run out of coffee, and we're going to have it at a good cost.
That's going to be it for the video, guys. If you didn't enjoy, make sure to subscribe and like, as I did work really hard on this video. It would mean a lot to me if you actually did enjoy it to, like the like button, wink, wink. Make sure to have a good day. Stay safe, don't do drugs, invest in dividend stocks. Have a good one.